Good afternoon, everyone, and thank you for attending today's webinar. My name is Jim Bush. I manage the idea generation team at Briefing.com, and I also post under the name Growth Trader. With me today are Damon Southward, who posts under Scalp Trader, Brett Manning, also known as Chart Trader, Scott Smith, who posts under the name Blue Chip Trader, and Gavin McGuire, who's known as Event Trader. By the way, if you have a question at any point during the webinar, please submit them using the chat function, and we'll answer as many of them as we can during the Q&A portion. So the title of today's discussion is how to avoid some costly mistakes when markets shift from overdrive to neutral. Clearly, we're still in the overdrive phase right now, but underneath those new closing highs every day in the major averages, conditions are starting to get pretty choppy now that earnings season is in the rearview mirror and we're approaching the summer months. So today we'd like to discuss some common mistakes made during periods like this, as well as give you a sense of our individual game plans. So without further ado, I'm going to hand it off to Brett Manning.
Yeah, hi, thanks, Jim. My name is Brett Manning. I'm chart trader on the site, and I just wanted to start off quickly with an outline of some of what I've seen going on lately and commentary on the broad market move and the shift that I think that's really been taking place over the last couple of weeks. I think there are a lot of folks maybe that are just kind of starting to get into the market that haven't been really focusing on the stock market so much for the last four to 5 years, really, and that's kind of what I sense is shifting a bit right now. We've had a market. First of all, if you see the chart on your screen right now, what that shows you is the American Association of Individual Investors bull-to-bear ratio, which is really, I think it's essentially the bulls divided by the bulls plus the bears. So what percentage of those who have a view on the market, what percentage of those are bullish? And that's just from the sample size for the American Association of Individual Investors. But this survey is really good, and it's one of the sentiment data points that I lean on a lot to really try to understand what sort of market environment we're in. And I put this in my most recent chart book piece as my first chart because I think it's really important to understand that normally when you see the line on the bottom of that chart down toward the lower end, and in this case it was actually making a new multi-year low, what that means is that even though the market had been rallying so far and really consistently over years, that the average individual retail investor is still really bearish, or at least is having a really, really hard time getting themselves comfortable with the idea of chasing the market when it's making new highs. And to me, as I detailed in that chart book, this is a really defining point in the market environment. You're in one of two markets, a situation where the market's going to come in, at the top of ranges and find resistance and roll over because the institutional crowd gets leaning too long and there's really nowhere else to go, or you're in a different type of market, which I think that we've just started to shift to now for the first time in years, where when that institutional crowd is leaning long, there's a whole huge another resource that can come sweeping in and push the market higher and take it off the hands of that institutional crowd, or at least make it really difficult on people shorting, and that's the retail public. And I think that what this chart shows is, into the jobs report a couple weeks ago, we had a situation where people were really ripe to finally start chasing the market, because this chart really, to me, shows involvement. When you have the line down at the lows while the market's making highs, you've just got a market that's rallying without any involvement from the retail investing public. And that's really a big difference maker. When you saw it in 2010 and 2011 making its highs, it was a very different picture. You had some people who were trading on the long side from the retail public, and the market had a chance to come in. But right now, people have been skeptical as this market's moved back toward the highs it was at in 2007, so we're seeing this breakout. Can you go ahead into the next chart? Okay, this is, I'll just spend a moment on this one, but I think as I wrote there, this chart should really just kind of speak for itself. This is the average Wall Street strategist allocation for stocks. And you can see, where it's been for the better part of the last 15 years, and the type of beating that it took even in 2012 as everybody started to try to call the top and say that, valuations were stretched. When you're in an environment that can include some multiple expansion, like the environment we're in now, that sort of thing can radically shift. And as I wrote into the chart book, the job of a bull market is really basically to travel us all the way along the spectrum of risk aversion to risk acceptance. And as this chart shows and the previous one shows, we just really have not gone along that spectrum very far, even though the market seems like it's gone a long ways. And this is the point I was trying to make a couple weeks ago in this chart book, is it's just really dangerous to sit there trying to fade the market when it's in that kind of state. So go ahead to the next chart. So when I'm trying to figure out when I'm going to start actually looking to short something like the S&P, actually my favorite short-term timing chart for sentiment data is this one. This is the, and I comment on this one all the time in my ETF daily notes as well as in the chart book. This is the options ratio that measures retail investors when they're opening positions in the options market. So this is the ratio of puts to calls, and it's inverted on this. So when it goes up really high, that means a lot of small traders are just buying tons of calls. And as you can see in 2012 in March, and again in September, it called the top almost perfectly. And you can see right now it's just basically sitting in the middle of the range. So we still probably have further to go along that spectrum before we really get people who are leaning too far on the long side. And this is something I look at just about every day to try and figure out whether or not it's time to fade a trend like this. And so I've been really kind of trying to keep myself from doing that at this point. That's all I have to say right now, and I'll be back for question and answer.
All right, so now we'll move along to Damon.
Yeah, I thought those were actually some really compelling ideas, Brett. You know, it really speaks to the power of the ability of this market to go higher and to really focus. It really focuses my attention on the short squeeze play. Everyone's trying to short these squeezes, and especially ones with the small floats and already high short interest. And that's why you're seeing names like Tesla's and the Netflixes of the world just really break out and take off. So just something to remember, look for pullbacks to play short squeezes, and also be prepared to play squeezes on new names that are heavily shorted with high short interest. I mean, those names have been running for 2, 3, 4 days consecutively, and they've been probably the best plays in the market the past month or so. Moving on to my specific area of focus, so what I really want to talk about is where I've been making money this year, and I want to highlight a couple of the areas. So I've really moved into distressed debt and distressed equities quite a bit over the past 6 months or so, and it's done really, really well for me. I know some of you probably traded Fannie Mae and Freddie Mac with me this year. We're buying that in the low 50s, and today those went out at like $1.40 or so. You know, my original plan was to buy those and hold on to them for a move just like this, but just when I was trading them, and as you know, we were buying quite a bit of it, and the size was so large and the moves so rapid to the upside that I just thought it made a lot of sense to lock in profits. The Fannie Mae prefers, which we're buying down at the low 3s, went out at above 6 today. So my point with these is on the distress side is you want to have something going on in your portfolio, in your account, that can deliver the home run profits. So while you're out there trading every day, you want to have some seeds that are planted that are going to come through for you when you're not even really paying attention, and you're going to get those 100, 200, 300% gains. And those are the type of things that really contribute to your overall performance at the end of the year. And so obviously I highlight a lot of those ideas. Event Trader is working with me in the distressed area and discusses a lot of these ideas. He's been talking about Fannie Mae very actively. STP is another name he's been talking about. And so I would say don't, you know, for many, many years I stayed away from the penny stocks, but when it comes to distressed situations specifically, I think there's a lot of opportunity there, especially given that a lot of hedge funds are actively shorting these distressed names when it seems like the companies might be on the ropes a little bit. So you get situations where DebtWire or some other news, some other organization puts out a report on a stock that's trading at $4 or $5, and you see the the company might be hiring restructuring attorneys or a restructuring firm, and the stock goes from $4 or $5 to $2 really quickly. And you know, shorts are beating on that thing all the way down, hoping that it is going to be a bankruptcy situation, and they may be shorting it all the way down below $1. So at some point, that short interest has to unwind. So you know, one of the things we're looking for, like for example with STP, when the day they filed bankruptcy, we caught that one at 30 cents, and by the end of the day it was at 60 cents. You know, it's 100% gain, and the total trade there was that we all knew that bankruptcy was coming, and that there are a lot of shorts in that name. So why not swing the big bat at that and try to take advantage of those shorts who have on extremely large positions who are ready to lock in their profits. And we saw that STP run from 30 cents to 60 cents in a couple of hours, and it's not uncommon to see that type of situation. So, definitely, on the distress side, pay particular attention to Vent Trader or myself, because we're actively following that space. The other thing I kind of harp on, and a lot of people have kind of started to pay attention to it with me, is the yield portfolio. I have most of my assets in my yield portfolio so that they're invested at all times, generating income. And at the end of the year, that really starts to add up. You're talking about a relatively passive strategy where I'm focused on making 7.5%, 8% coupon, then another 10 to 20% in capital appreciation based on positioning on a relative value strategy. And, it really does add up. So you're not forced to go out there and try to hit singles, hit doubles every day. You don't have to play every day. When you have your money invested in this, at least for me personally, when I have my money invested in this yield strategy and I have dividends and distributions coming in every month and every quarter, I just don't feel the pressure to trade every day. It allows me to be more selective and sit there and wait for compelling opportunities. So I've talked about that a lot before, but one of the things I'm really focused on this year in particular with the subscribers is making sure that you have kind of a diversification of income streams. It doesn't all have to come from trading. You want to mix it up, because you'd be surprised by when this money starts flowing in from other sources rather than just the intraday day trading, the amount of stress that it kind of unloads and that you take off of your back, and just how your overall performance picks up. So I'm going to stop there and pass it on to Scott, and feel free to ask questions, and we'll tackle them at the end of the webinar.
And this is just a reminder as well, if you have any questions, submit them at any time in the chat as well.
Thanks, Damon. My name is Scott Smith. I'm Blue Chip Trader. Just to build on what Damon just said too, I just want to start off and say I do have, I have 3 trading accounts. One is actually an investment account, a long-term account, and I have stocks mostly that pay dividends. They're blue chip trading stocks like Verizon paying like a 4% dividend. Freeport McMoran is a gold and copper stock. Picked that one up just recently under $30 for a 4% dividend as well. And those are just more blue chip staple companies, really well known in their field, with nice sized dividends. And that's in a totally separate account. The stuff you're going to see on the website, this is my trading account. All the blue chip trading calls that you see, those are just more of the hitting singles and the occasional doubles type of trades. It's kind of more of your the money that you can afford to risk and to play with. And I try to grow that, each day with just probably about 2 or 3 trades each day, and hopefully I try to turn them into a swing. Do I just hit this button here? Yeah, just a quick rundown on my style that you're going to see on the site. I am a combination of a day and swing trader, and really what that comes down to is if I have a winning day trade and I've already taken a partial off during the day for about a $1 or $2 gain, I'm going to hold it overnight. It's the old concept of letting your winners run. I'm pretty much willing to, as long as I have a gain in the stock and I've taken something off on it, I'm just going to try to let it ride for as many days as possible, as long as that momentum can continue. Each day I pretty much I have a set format that I go through each day, and or either every morning or every evening. And the majority of my ideas are going to come from the TA page scans, as well as from the liquid momentum focus list. These are really high momentum names. The scans themselves are just patterns that I've recognized over the years. They're computer generated, and I pretty much just go through all of them each morning or each evening. And it takes me all of about 10 minutes. And you just really find some nice bullish flags there, or bearish flags, or breakouts. It's kind of like these vague textbook type of technical patterns. I really try to stick with the ones that are the most clean. If they look too sloppy, too convoluted or something, I just try to stay away from that totally altogether. If they also wind up being key focus names on the liquid momentum or emerging growth list, or our value list, I'd take a closer look at those, because those also incorporate the fundamental side of those stocks, and I think those have a better quality to them. They have a better following, institutional sponsorship to them. So I definitely want to pay more focus more attention on those names. And also each night, if I run out of time or whatever, I always want to know what each sector is doing. And I think the S&P 500 has 9 sectors. It's the XLI, the XLP, the XLE, the XLY. I run through all 9 of those charts every night. I always want to know what's the leading sector, what's the laggard sector. That always gets me in the right mindset to know where I should be looking for trading opportunities the next day. And once the market opens, I write a pre-market plan, but I'm always ready to ditch that plan if necessary, depending on how you try to prepare for the day, and you try to have a layout that goes forward. You have your levels all in place, but as soon as the market opens, you really have to pay attention to how the buyers and sellers are reacting to key levels. Are they pushing it in one direction? Are they squeezing? Are they dropping stocks hard? And you want to pay attention to the internals. And I'm going to basically throughout the morning, the first hour, the first half hour, and up until midday, I'm usually throwing out what I call the blue chip trader notes. And I'm going to basically give my read on the internals and who I think is in control of the market that day and how we should be situated. For briefing itself for the site, this is just a quick glance. I'm going to show you about 4 screens that I use. So this is my main screen. It's briefing.com. It's the dual in-play site. I filtered on the left-hand side to show basically all the fundamentals that come through the site, the upgrades, downgrades, any sort of headline news. You can go to select a filter right here, and there's a whole drop-down menu in which you can separate everything. And then on the right side, I try to keep all the technical comments, all the trading commentary. I find it to be very useful just to really kind of focus in and see what's moving the market at certain times. This is just another one of my screens. If you have it's mostly focused on the liquid momentum screens as well as the GrowX components. I do have also on the side, I have the stocks that I'm long or the stocks that I'm short. And I just kind of keep track of what's moving. Pretty much I spend a majority of the day just scrolling through all these charts of about 100, 150 stocks, just constantly scrolling through them, trying to see which ones are moving, which ones are setting up really nice. Over on the right, you can see that I basically also have the market internals, tick, trend, VIX, advanced decline lines, up-down volume, the futures, and a whole bunch of sectors to see what's leading as well. And this really kind of just keeps me on the right side of the market, and that's really what I'm trying to do each day is just try to sit there, hit that single, and hopefully it's in a leading stock or a name that I like. This is another screen that I use. It's 3 charts. The chart on the left that's really vertical is my weekly chart. Just something to put everything in perspective. You always have to focus on the long-term momentum of a stock. Usually if it's up for the week, I want to be a buyer on a daily chart on weakness. And if it's down for the week, I want to be selling into strength on the daily chart. This big one here with all the lines, like all the moving averages and every indicator, and this is the one I draw all over all day long. This is usually going to be my 60-minute chart, my 30-minute chart, or my 5-minute chart. And it's the one that I mark up all the time. And I think it's also very important that if you are a technically oriented trader, that you also have one chart that is completely naked, completely empty, nothing on it. It's amazing how I actually reference this bottom chart here so much more frequently than any other chart out there. It's just a nice, clean-looking chart, and I definitely highly recommend keeping some sort of naked chart on your page, on your screens all day long to pay attention to. Another screen that I look at too. This is more of along the lines of those sectors that I was telling you about. The top 3 is the SPY, the QQQ, and the IWM Russell. Obviously, I always want to know where they're doing, if they're above their morning ranges, below their morning ranges. These are 5-minute time frames. I want to see where they are according to the afternoon ranges and where they are where they are going into the close. Below, I have 3 main sectors that I follow a lot, which is financials, energy, and industrials. And then on the bottom, I have daily charts of crude oil, gold, and the U.S. dollar. Overall, I can usually watch these charts and just have again, trying to get a really, really good sense of what's going on in the market and who's in control. Just to say who's in control as well, obviously if you see more green than red on the screen, you know that you're in a massive type of broad bull move, especially among these leading names. And you probably want to avoid shorting stocks at that time, vice versa if they're all in the red, which we haven't seen in quite a number of days. Generally speaking, I write a bunch of columns from swing trader to liquid momentum. And the main premise is that if a stock is acting strong or looking strong or it's got strong fundamentals, you should be trading it on the long side. And I know this sounds like common sense, but it's really, unless you're experienced and you just really know what you're doing and you're the most nimblest of traders, to get in and out of stocks, trying to catch falling knives or trying to fade, high-speed momentum names, you really want to go with the trend as often as possible. It takes a long time, and if you do go counter trend, it's more of a scalping opportunity, and you just have to be ready to take your losses. This is a great example of trading in context too. Apple, it's basically trading below its 20-period moving average, its 50-period moving average, and its 100-period moving average for about 7 months now. Every time a stochastic's gone into overbought condition, it set up a really nice swing short trading opportunity. And surprisingly, this is a stock that everyone's just questioning, how it's gone down the last 9 months. There's buyers on almost every single new low, and it just could have been much more profitable if just focusing on the bigger picture and just trading with the trend and trading in context with everything. Current market conditions, again, this is kind of like the opposite of Apple. This is the S&P chart, and you can just see it's just riding the upper Bollinger Band higher recently, consolidated, and it's breaking out higher. That doesn't mean you can't fade any stocks that have run up 4 or 5 days in a row and are overextended. You just have to be more nimble. You got to be quicker to take your profits. And you have to be ready to get out of them too, or else you're going to get stuck in some sort of massive short squeeze like we've seen the last 2 days. This chart's interesting to me. It's basically the percentage of S&P 500 stocks that are above their 50-day moving average. This is a chart over the last 5 years. Every time we get a reading above 90, the market tends to stall out. So I think going forward, it's not a sign of a particularly top, so don't think you have to start shorting the market heavily. But it definitely means that it's probably sometime here in late May into June, you might want to take your foot off the accelerator if you've been buying. Let's put it that way. Maybe lock in some profits, look into maybe selling some out-of-the-money calls on long positions, maybe even protecting some positions with some long puts. It's just usually when the market gets this far extended, the momentum starts to wane. You're not seeing that right now because we have this really big short squeeze mentality going on. It just means you just need to be just a little bit more cautious. Maybe cut your trading size in half. Slow down the amount of trades that you're taking. Don't bet aggressively, in one direction, long or short. And here's just some general trading rules that I do follow. I hardly ever carry a losing trade overnight unless it's hedged with a short position, usually an ETF of sorts. And I tend to give stocks a lot of wiggle room. As a technical trader, I realize I'm never going to be picking the exact bottom and the exact low. And usually when I want to put a stop somewhere, I'll widen it. If I want to risk like 50 cents because that's the low of the day, I'll just say, all right, I'm risking $1. I always try to go a little bit wider because I know that level is going to get taken out. I know stops are going to be run, and then the stock's going to move in my favor. So I try to be a little bit more fluid with the way that I approach the market. If that suits you, then by all means, you're more than welcome to piggyback on a lot of my trades and my calls. And if you feel free to have any questions about anything, you can contact me at swingtrader@briefing.com. We'll move the webinar on to Gavin. Yeah, Event Trader.
Hey, I just want to make a quick point. This is Scalp Trader. Speaking of that squeeze mentality we've been talking about, Tesla, which Scott has a swing trade on right now, is up another 7 points in after hours after filing to offer stock. Stock's up 7 points.
Yeah, I wasn't, just to be totally honest with that one, I took a lot of it off when it was up $6 this morning, and I held a little bit overnight. I was kind of nervous just about the overall market, the way it was behaving this afternoon, so I did throw out a hedge in the UPRO, which is the S&P double or triple weighted, I believe, just because I was just a little bit nervous about carrying that position. It's a very volatile position. And I think initially dipped on the shelf offering, but it's nice to hear that it's trading higher now, so I don't have to worry about it.
This is what's going on. Everyone, there was speculation of the shelf yesterday of the secondary offering. People got short on it. Elon Musk announces that he's going to buy into the shelf, and I mean it's just a total short squeeze by the people who got short yesterday in anticipation of the shelf offering.
Nice.
Okay, how's everybody doing out there? This is Event Trader. My real name's Gavin McGuire. Just wanted to talk to you a little bit today about my role at the company and some of the different things that I look at along a lot of the things along the lines of what's been touched upon already. I follow everything from the macro to the micro level for the company. I do a lot of the posting on the geopolitical events going on, a lot of the Fed comments and everything. So just wanted to take a look at one macro and one micro level event that's going to be coming up in the next few days, and just kind of touch along the lines of some of the subject that we've been covering here. One is for avoiding pitfalls. One thing I wanted to point out was tomorrow is an extremely busy day from the Fed speaker schedule. I posted my day ahead comment under the event ticker for anybody that would like to check that out. But we've seen a lot of movement in stocks and indices. Perhaps the only time we've ever seen the indices fall lower is when there's been hints of QE being taken away. So I wanted to put the speaker schedule on your radar to be aware that we might see the dips from here and there. But what I did was I posted what the schedule was, when everyone was talking, whether or not they're a voting member, and what they previously said. Basically, most of this is going to be all white noise tomorrow. It's just going to be a lot of people arguing their point with what the next direction of QE should be. However, you will see market participants try to take this and either press the market lower or rally on it. In general, anytime we've tried to press the market lower on it, it's quickly reversed and whipped us higher. So there's a number of hawkish speakers tomorrow, including Fed's Fisher and everything. So just to be aware of what they previously said, I posted that all in my comment. The big event for the macro level is going to be May 22nd. That's when Fed Chairman Ben Bernanke is going to sit in front of Congress and testify on the economy. That's where people are going to be looking for any hints at any possibility of the Fed tapering their QE purchase. Given how easy monetary policy has been such a key driver for here, Japan, and now, of course, talks of the ECB possibly switching from austerity to that, it's an important event that you want to have on your calendars. But I just wanted to touch upon that in terms of a way of avoiding pitfalls, and that is tomorrow there is going to be a lot of white noise out, a lot of headlines that will rattle the markets, but in general the trend of buy the dips is still in place. So keep that in mind for scalping opportunities potentially on the short side, but also be aware that any movement down could easily be whipped back higher. Now, the other thing I wanted to talk about today was on the micro side. One of the best ways that I assist traders is through my earnings previews. And with that in mind, I'll be doing one for JCPenney's tomorrow. They report after the close at 4:30 Eastern with a conference called Follow at 5. Just wanted to take you through some of the key points of that and basically give you an idea of how I put together an earnings preview. And, any questions, obviously, feel free to ask towards the end. Basically, the first thing I'll always do is look at a chart. Now, when you're looking at a chart of JCPenney's, you can see today was a perfect example where it is basically bounced off the 14 level from mid-April and been able to push up to the 1950 area where it was rejected today. That's basically the gap down resistance level that it ran into in mid-March. Now, mid-March is when they reported earnings, horrible results, same-store sales down 30%, and the solvency issues really came to the forefront when people started discussing how big of a cash burn rate they had. stock tumbled from 22, which was just below the 200-day, to the 14 area. Now we're working our way back up, and it's hitting some key levels just ahead of earnings, with that breakdown resistance level staying just above, and also the 200-day at the 2032 area. So these are going to be two key areas to keep in mind when the company reports results tomorrow. The one thing that you also have to keep in mind is the company already pre-announced numbers. So really, a lot of the negatives already been taken out of this. We know that revenues are going to be down 16%. We have a fair idea that gross margins will continue to run in the 23% level. But these are all key metrics that people are going to have to keep an eye on tomorrow when the company comes out, that and same-store sales. But this is going to present a very nice potential opportunity for a breakout if the momentum continues to build and people start getting the idea that the Ron Johnson experiment has ended and a turnaround's underway, and they're seeing improvement in the trends of shopping in the month of May. To point this out, one of the things that I'll point out in my earnings preview tomorrow, back when they reported Q2 earnings, there was a lot of concern about the company, but they ended up posting numbers that missed drastically. They had a big drop in growth revenue. However, Ron Johnson was able to get across the message that the trend was turning around, that the steps that he was taking to improve the company were working, and the stock was able to squeeze from 24 to 29. Now, I want to note this because short interest is still running around 23%. We could see a similar move tomorrow in JCPenney's, because if people start getting the idea that the Ron Johnson experiment has ended, and all of a sudden the new way with the deep marketing, the sales cuts, everything along those lines is back in place, and customers are coming back, we could see that short interest be squeezed, and for us to break through some key levels and see this as a potential nice extension. We've already seen a number of positive comments out from different companies ahead of the earnings, with channel checks from Cleveland Research saying they look fantastic. Both Bank of America just recently upgraded them. Guilford Securities just out positive. Buckingham, long considered an axe in the retail space, out positive on the name. So just wanted to point this out as one specific trading opportunity that touches upon the recent trends, and that is short interest squeezes running after earnings. We've seen this in soda. We've seen this in GMCR. We've seen this in Tesla. So this is just something on the micro side that I'll be talking about tomorrow. Full preview and everything. If anybody has any questions about it, feel free to contact me at gmaguire, and that's M-A-G-U-I-R-E, @briefing.com. Thank you guys for your time, and I'm going to pass it back to Jim Bush, our moderator.
Yeah, hi everyone. This is Jim again. I'm going to keep my my comments brief, by the way. And also, we have some good questions coming in. So keep them coming, and like I said, we'll address them in the Q&A, actually right after I finish with my thoughts here. Just for those of you who aren't familiar with me, I post under the name Growth Trader, ticker is SetupX. I'm a growth stock investor, focused on small to mid-cap growth. I consider myself a position trader, so my holding period is typically measured in weeks to months. I also incorporate both fundamental and technical analysis as well. So one of the key points that I'd like to make is that when the market is exceptionally volatile or is in the midst of a transition, I think it's extremely important to slow down your trading and only act on your highest conviction ideas. The reason is because, say, right now, well, it seems the volatility is all to the upside. The higher daily closes are actually masking some increasingly thin, sloppy action. Damon touched on that when he talked about these big short squeezes that we were seeing. You see that a lot recently, and this type of sloppy action isn't reflected in the closing prices of the major averages, but you can see it by observing how the leading stocks are acting on an intraday basis. So one particular thing I'd like to highlight in this regard is that I've seen a lot of high-quality growth companies report good quarters and then see negative reactions in their stocks. So for me, this is one of those yellow flags that isn't reflected in the major averages, but at the very least it's signaling a rotation. It's actually pretty similar to what we saw last summer when money flowed out of sort of the traditional growth industries and into cyclicals. Seems as though we may be in the early stages of that type of rotation now, or even an acceleration of that type of rotation. It's not a red flag, but it's something to inform your trading. Now, as a position trader with a multi-month time frame, I think it's critical at times like this to distinguish between your view of a company and your view of the stock. I mean, that sounds pretty like common sense, but it becomes increasingly important as the market gets more choppy. So for example, there are a number of companies that I consider to be top-tier emerging growth companies. You know, some of my favorites that I post on a lot are ServiceNow, PowerSecure, Imperva, Cree, Splunk, Pros Holdings, and X1, even though they had a big miss last night. Almost all of these ideas, by the way, come from the emerging growth stocks rankings or our IPO analysis feature, The Next Big Thing. But even though I like these companies fundamentally, I make a clear distinction between my view of the company and whether I think the stock offers a good risk-reward over the next several weeks or months. So what I'm finding these days is that while I have a number of high-conviction ideas on my watch list when it comes to the fundamentals, I'm simply not seeing many lower-risk setups and entries. You know, and again, this is with a multi-month time frame. In other words, a lot of these names are being forced to chase, and those are higher risk setups, and those are ones that I'm really just not willing to chase after, even if I like the name. So right now, my rule is to only act on high conviction trades. So even if I like the fundamentals, it has to look like a lower risk type of entry. If it doesn't pass the high conviction threshold, then I'm just simply going to pass on it. And in the meantime, even though that's led to a decrease in my trading activity, I'm still very engaged in the market. I maintain and frequently update my watch list of favorite names, and again, most of those are drawn from emerging growth or the next big thing. And so as the market transitions, I make sure that when the trading conditions are appropriate for me, I'll be ready to act on my ideas. Those are basically the points that I want to make. It's really choppy out there right now, even though it seems like we're making a new high every day. There's a lot of short squeezes that are sort of making headlines in terms of the percentage gains, but under the surface, it's just getting very sloppy, which isn't surprising since earnings season is over and we're entering the summer. So that's basically my strategy right now, is to be just very, very selective. So with that, what I'm going to do is move on to the Q&A. So if you'll just allow one moment while we review these questions one more time.
Just to answer the point, this is Scout. You know, it seems like everyone's focusing on discipline, and there's a reason for that. We've been doing this for a long time, each one of us, and you know, I mean, my experience is that, you know, especially in a period like this, making money isn't the difficult part. It's not giving it back, and you really need to stay disciplined. Focus on top quality ideas and avoid the urge to overtrade just because the markets are open. It's a really key point. I mean, we've all, over the years, overtraded and given back gains, and it's a hard lesson to learn. So I just really want to emphasize that point. Wish someone had pointed that out to me early in my career. Would have saved me a lot of money. But you'll see us talking about it when we shift into those conditions where things are really choppy. We're saying, hey, go half size or don't trade at all. Get away from the market. Because sometimes the conditions are just terrible for trading, and you just have to respect that. You really have to respect that. Don't think you're smarter than the market. When conditions get poor, there's just, you know, opportunities are just fewer and far between. So be really careful about overtrading and giving back your gains.
This is Jim again. See one question here that we actually get quite a bit. It's can you talk about stop levels and how you determine the stops? I know all of us have different strategies for that, so I think we'll just each chime in on how we determine our stops. As for me personally, again, I have a longer time frame, and I use soft stops. So when I enter a stock, generally I always determine ahead of time where I'm going to exit the zone, but I don't place the order because what I see just over and over and over again is that obvious stop levels, you always get a stop flush there. You know, when you look at a chart and you see an obvious place to put your stop, chances are there are hundreds of other people that have put their stops right at the same level. So what I do is that if the stock comes in and sort of hits the level where I have my mental stop, I set an alert in my charting software, it goes off, and then I just watch it to see whether, you know, it'll often bounce back once it's flushed all those stops, and then I'll make a determination whether it's weak enough that I need to get out or whether that was just some noise in the chart. So that's my personal technique. I know the rest of us also have some thoughts on that as well. Brett, do you want to talk about that a bit?
Yeah, sure. For me, it's really simple. I mean, most of what I do has to do with some larger time frame ideas about the tone and the mode that the market is in, but then it comes down to tape reading. And you know, as I evaluate a setup and I get an idea of where the bias is on a particular tape in a particular play, and I start to see an advantage, so immediately my definition of the concept of setup comes back to whether or not there's a small space of price movement that would show me that I'm wrong. And that's my stop. So if I take, for example, the Netflix fade that I had this afternoon, I shorted the stock just right around 244, just under it. And if you go ahead and look at that chart, you can see that it made a high just above 245 on what was ostensibly an ascending triangle breakout, which was, to me, something that set up well as a squeeze pattern if there was anything left to really squeeze there. And when it failed to really trigger and cascade higher at that point, you know, I started thinking about it. That's a sign in the tape for me. I started thinking, hey, maybe people are leaning long, and we've really gone ahead and exhausted most of the weak-handed shorts as far as fuel for the move to continue. So I might start thinking about fading it. And then I watched it for maybe an hour and a half or so, and I started to lock into that idea. When I put the position on, for me, you know, I put the stop so that if it got back up anywhere around the 245 level, I don't want to be in it anymore, because at that point, you know, it's already signaled to me that the short's a good idea. If it starts to leak back up to that level, then I think that at that point, you spent a couple of hours following that failure at 245. You probably got a lot of weak-handed shorts coming in to look for that afternoon spill, especially the way that Apple was behaving. So for me, as it gets up close to that 245 level, you know, I want to be gone. So I set the stop just above that. If it had gotten back through, I really could have set it tighter. Honestly, looking at it right now, in retrospect, I should have had it as a dollar stop. I should have had it as 244.95. Because if it gets up anywhere near that level, I think that it's just going to start to trigger a cascade of stops and spit it up. Even if it does later reverse, I don't want to be in it for that 1.5 or 2 points that it shoots up through burning stops. So for me, I set the stops just on the basis of I look at the chart, I have a feel for the pattern, I have a feel for the tape, and I say to myself, if it does X, I believe I'm wrong. If that X represents a small price movement, then I look at it as a good setup, and I set the stop accordingly. That's it.
And Scott, I know you probably have some thoughts on this.
Yeah, just real quick. So, I mean, for specifically placing stop orders, usually just looking at the average true range, which is like a 14-period setting on most charting packages, you can just get a good feel of what the daily range of a stock is by looking at the ATR. So in most cases, like something like Apple, the ATR would be like 6-7 points. That's a daily range. I mean, that 6-7 points might sound like a huge stop, you know, for some, depending on the size that you're trading. But for somebody like me, I usually try to keep my position size somewhere attainable, you know, within management of the daily ATR. So for a stock that's trading, say, like a 1.5 to 2 point ATR, you know, I'm probably going to keep my stop somewhere around 1.5. And I'm also in the same camp as Jim. I definitely use soft stops much more frequently than I do hard stops, just because you get stopped out a lot when you put your order there in on the book. And also, I like to give myself, just like I said earlier, if I'm willing to risk like $1, I'm probably going to go a little bit further out and just say, all right, I'll set an actual alert on my software to go off on my screen when that gets close to like 75 cents against me. Or if I look at the chart pattern and I see it's completely reversed the day's gains or the day's move, well, then I have to probably reassess the situation and get out sooner. It's all kind of a fluid type of thing, but generally speaking, I go off the ATR, and when those levels come into play, I'm going to be a little bit more cautious and try to reassess the situation. If I leave the desk for whatever reason, I have to go to lunch or just out for the rest of the day, I definitely put in a hard stop, and I usually put that wherever I have to, because I'm just not watching the market.
Okay, another question that we have here, this is actually one that we tend to get fairly frequently in our feedback page. I find it difficult to fade certain stocks, and the question really is what's sort of the best platform for that if you're trying to enter some of the short calls. Damon, I know you have some thoughts on that.
Based on my own trading and based on feedback that I've received from customers, Interactive Brokers tends to have the best locates, the best borrows, and yeah, so those are my thoughts. They usually have it, and I don't post a stock unless a short, unless I check with Interactive Brokers first to see if they have any shares available to borrow.
One final, one question too. Has anyone here made a bad trade recently, and was it due to bad risk, or how can I learn from it? I know Event Trader just posted actually a long comment on, was it Priceline?
Priceline, yeah.
Yep.
Yeah, thanks, Jim, for pointing that out. But Priceline was a perfect example of, kind of not paying attention to the trends and, not seeing the writing on the wall. It was an earnings preview I had done, and, I was looking very closely at the guidance for Q2 and having that as a major impact on the trade. Now, they came out with very poor guidance. They guided revenues below consensus. Priceline tends to be conservative, but this was even worse than expected. So the stock tumbled on it, and I thought we'd get a bounce, but I thought that bounce would eventually be faded. But this was a perfect example of not really paying attention to the type of trading environment we were in and trying to put a stop in it. I lost about 4 points, and the stock just continued to go cruising higher. I mean, it was a perfect example of what Soda did, what Green Mountain did, and I put together, it's posted in under event on Friday, a full mea culpa of the whole poor trade and, kind of learning from it. That would be a good example for somebody to go through and, trying to find out where the faults are, not paying attention to the market and having a little too much faith in your own conviction and your own analysis of it, not really reading the chart and the price action that was going on in response to some of the comments on the conference call and the report itself and, of course, the stock and nature of the market. So I'd highly recommend doing a search under my event ticker. And like I said, Friday morning I posted the full comment on Priceline. Be a good example of what not to do. So thank you.
Yeah, all of us have had, no one bats 1,000. So I thought Gavin's comment was particularly good in terms of walking people through his methodology.
Hey, Jim, I've got one to add to that real quick.
Oh, yeah, go ahead,
I just wanted to kind of highlight this because it's something that was so obvious to me in retrospect, and somehow I didn't act in any way in accordance with what I've learned over the years. Yesterday morning, right off the bat, in my kind of typical tape reading style, I was watching the Tesla gap up, and it was trading in the 93 to 93.50 area, and I was watching it pre-market, and just really I started to spot some things that led me to believe very strongly that there was going to be some strong selling off the open. And with it sitting up there, it had already gotten rejected early pre-market. I mean, an hour and a half before the open on an attempt to bid through 95. And then it actually had some pretty strong pre-market volume, so I was getting a good feel for the type of order flow that was going on in the stock. And so before the open, about 5 or 10 minutes before the open, I got short the stock in the 93 area, and for it to come back down and cut through the 90 area and fill the gap. And I mean, it was correct as far as watching the order flow that was going on right there, but just somehow I just didn't think about the fact that, as I alluded to earlier, that we've got a lot of retail traders that haven't really been involved in this market in a while that are suddenly, watching stocks a whole lot more, and the order flow that hits once the bell rings, with all of the orders stacked up that the market makers basically collect and sit on, and then spray out once the market opens, is obviously something where if you've got good pre-market news like the stock did to gap it up as high as it was, people are sitting on all those orders. The market makers are going to sit on all those orders, and they're going to shoot them out right off the open. So of course it rocketed up about 5 points in the first minute and a half, and then turned right around and dumped 15 points. And had I been thinking straight, which I should have, that just would have been an absolutely golden short. I knew, in retrospect, looking at it, how easy this should have been for me to make at least 10 points with a full position on. Based on what I saw pre-market, I already had the edge on the stock, and for some reason, I just felt like I was going to miss it. Like in the 5 minutes leading up to the bell, the stock was going to go 3 points down because I knew so clearly what was going to happen. But then, of course, I had no risk parameters because that spray off the open, off the bell, can be 5% one way and then back the other. And all I really needed to do was let the bell ring, let the market maker hit that thing to the upside, let all those orders flush, let the people who are sitting short overnight, hoping somehow, praying for rain to get them out, let them go ahead and cover. And the second that first couple of minutes of momentum started to drain out of the stock, that would have been the short. And it's something that I've done before. It's an easy setup. So I would say, kind of have that sort of bigger picture awareness. There are certain structure of events and certain things that you can count on in the market that really don't have anything to do with the order flow that you're watching or the company that you're watching or anything else, that are just part of the structure of the marketplace, just to make sure you keep those things in mind and use them to your advantage. So I just wanted to throw that one in there.
Okay, I think we have time for just one more question before we wrap it up. Let me see. Well, here's one that again, comes up fairly frequently on our feedback page. Can you comment on how many traders react to your trading calls, or how much volume comes in following a trading call? Sometimes it can be difficult to get a reasonable fill. Damon, I know you talk about this quite a bit, so I'll hand this one over to you.
Yeah, I know personally there are a lot of people who follow my calls, and so because of that reason, especially when I'm trading some of the high volatility names, and a lot of times the high volatility names are the thinnest names. They have the smaller floats and the higher short interest and the lower volumes, and even though they might trade 500,000 or 1 million shares per day, they trade in a very thin fashion. They might, if you have a lot of people trying to follow you into a name, it might gap up 50 or 60 cents. And I talked about that this morning, actually. I was highlighting several names today that I thought were ideal squeeze plays. I didn't put, I'm buying right here with this specific stock, understanding that if I said that, everyone would have gotten bad fills. So what I did was highlight the fact that I thought these were attractive squeeze opportunities. And so, that does become an issue sometimes, just the ability to get execution, and particularly in the names that I trade, just because they are the names that are movers, and I try to stay on top of those particular type of names. So I guess one of the things that I try to point out to people is you don't have to chase the name. You can let it come back. Oftentimes I'll highlight an idea and it'll pop, but then it'll come back. So don't go chasing names. Give it an opportunity to come back to around the entry price and go to work from there.
Okay, so that's all the time we have. Thank you so much for attending, and a replay of this webinar should be available tomorrow. If you have any further questions, feel free to send them to us via email. You can send it, you have the sales email address on there. You could also send it to strategy@briefing.com if you have any further questions, and we'll be happy to write back to you. So that's it. Thank you.